Hello, Nebraska, and welcome to this week's edition of the Retirement Compass, the show dedicated to helping you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio are two members from Stonebridge Wealth Systems based right here in Nebraska. We have Tim Kulhanek, he is the co-founder and a financial advisor, and Jeremy Gove, who is a partner and financial advisor. The title of today's show is How to Remove Your Wealth from Washington. If you are concerned about your potential tax burden in retirement and want to learn how to minimize it potentially, you're not going to want to miss today's show. Tim and Jeremy, great to be with you as always. How are you this week?
Good to be back. We're doing great. Thanks.
Good.
Yes, very good. Thank you.
Well, I know we have a lot to get to today, so we're just going to get right to it. You know, the reality is it can be really frustrating when you spend all of your life working so hard to accumulate as much as possible for retirement. And one of the biggest detriments in retirement are taxes, whether we realize it or not, whether we want to admit it or not, right? But we're going to be talking about lots of different ways that you can actually protect your retirement savings from paying unnecessary taxes. We're not talking about tax evasion. We should set that up front, right? But we don't want people to pay any more to the IRS than they are legally required to pay. And so that's what this show is going to be all about. But before we dive into some of the common types of non-taxable income, I want to first start by establishing two things. I think it's really important to set the tone for today's show. So first off, why is it so important for folks to pay attention to their potential tax bill in retirement?
Well, it's a really important question, Kristen, because one of the biggest bills that you'll pay in retirement is taxes. And so when we sit down with clients, you know, we sit down with clients all the time, or prospective clients who come to a taxes and retirement workshop, or maybe they see this show and want to, you know, sit down and talk to us. One of the questions that we go through is, where are you at in your tax bracket? And probably half of the people know, or they're not sure. You'd have to ask my CPA. You know, that's the typical question, and it's understandable because for most people they don't prepare their taxes, so that's the answer. And so. But they can answer most of the other questions about the retirement plan. And so we talk a lot about just knowing where you're at, because if you don't know where you're at, then you can't plan from there. For example, you know, you can be in the 12% tax bracket today and make up to, it's around $94,000 before you jump into the 22% bracket. And so if you think of that, if your income, your Social Security, and money you're withdrawing from your IRAs is getting you close to that $94,000, and you decide you want to take an additional withdrawal, well, that additional withdrawal is going to come with additional tax penalties or tax assessment, maybe not penalties, but you're going to pay more taxes is the bottom line than you need to. And so if we're doing that in December, maybe that plan is, okay, let's hold off. Let's take it out in January, you know, because that might be more efficient for you. So the bottom line is just knowing where you're at. And I think we talk a lot about the decisions that you make today are going to have a significant impact on your future. We talk about that with Social Security. When should you draw Social Security? Where you draw your income from is a big deal, because that's going to have a huge impact on how much taxes you pay. And so,
in what order, right?
And in what order, exactly. And so, but it's just important to have a plan is the bottom line.
For sure. Well, the second thing I think it's important to presence for folks is that you all are not CPAs, you're not tax preparers, but you are financial advisors who engage in the strategic tax planning process. Share with our viewers a little bit about what that actually means and why it's so important to focus on doing this tax planning that we're talking about today.
Yeah, I think the key word there is focus, Kristen. It's a great word. A tax preparer, somebody who's going to file your return, make sure your 1040s are ready to go. Hey, sign here, and we're going to e-file for you. It's a critical step as far as your financial plan. That's why, you know, at Stonebridge, we like to think ourselves as kind of your personal CFO. You know, you're still the head coach. We're maybe the offensive coordinator here. We're making sure that we're putting the right players on the field at the right time.
Right.
And that includes making sure that you have the right CPA or enrolled agent, some person who's going to be able to file your tax return for you. Because like you said, we don't do that.
Right.
But it depends on what hat you're wearing. The hat that a CPA or enrolled agent is going to wear is mainly the hat of a historian. So you're looking backwards. So I myself,
looking in the past.
Correct. So I myself work with a CPA, and you know, every year around tax time, you got to gather up all your documents, your 1099s, your W-2s. As a self-employed individual, you're gathering a lot of other information as far as, you know, what your expenses were for your business, interest payments for properties, if you're a younger person that has children at home, you're figuring out, well, do I make sure I count all of them too, because there's a credit to be, gained from the child tax credit. And then you're providing that CPA or enrolled agent all that information, and they're able then to put it together to make sure that you're getting all of the deductions and the tax breaks and the credits that you qualify for. Tax planning is a different hat. It's more of a looking out into the future type of a role, where we're trying to say, hey, what's your tax liability going to be 5, 10, 20 years from now? And again, we talk about this an awful lot. There's a reason why, there's a theme. The folks that watch the show on a regular basis are going to see, man, these guys talk about taxes an awful lot. You're right, we do, because we truly believe in our heart of hearts that's one of, if not the biggest threat to retirees' retirement security today is the threat of rising taxes. So what do we do about it? We make sure that as your trusted advisor, we're educating ourselves. We're constantly learning more and more about different changes to the tax law. There's been a lot of very substantial legislation passed in the last few years. If you think about it, since right before the pandemic, you had the Secure Act, you had the CARES Act, you had Secure 2.0, you had some other more like omnibus bills that slipped in there a lot of different changes to the tax code that people just don't realize. So I talk about how I was recently in Indianapolis for the Ed Slott Elite IRA Advisor Group. I want to make sure that we're staying abreast, our team is staying abreast of all these changes so we can educate folks on ways to protect themselves, keep their money in their pocket, at their household, in their bank accounts, and out of Washington.
Exactly. It's at the end of the day, it's not about what you have, it's about what you get to keep, right? Exactly. And taxes are one of the biggest threats to that. So that's why today's show, again, the title is How to Remove Your Wealth from Washington. And we're going to go through some specific types of non-taxable income and share with you some of these proactive tax planning strategies. So first on the list, this is several types of income that the IRS cannot touch. So we're going to go through as many of these as we can today. First up is Roth IRA account income. So let's talk about Roth IRAs. Let's talk about Roth 401ks, which are a new option for a lot of folks, and why that can be so strategic.
Yeah, so Roth IRAs, they're going to grow just like a traditional IRA. You're not going to pay tax on it as it grows. But the big difference is once you start pulling that money out of the IRA, or the Roth IRA, there is no tax. There are some rules that you have to follow. And so one of those rules is that you have to, the distributions need to come after the 5th year of making your first deposit into a Roth IRA. And so now, as you mentioned, with a Roth 401k, many employees can start doing that, in their 30s. And so they're not going to touch that money for many, many years. So that really doesn't come into play for them. But if you're 60 years old and you're thinking about, okay, should I start doing a Roth IRA? We might want to do a little bit of planning just to make sure that you're not going to need to touch that money right away. We need to have that 5-year deferral. But there's not a lot of rules with it. That's kind of the key one. There are some benefits if you are younger to where you can actually use Roth IRA money to help pay for school. Now, there's some strict guidelines that you want to make sure that you're following so that you're not going to end up paying tax or penalties on it. But there is some opportunities for that as well. And so with the Secure Act 2.0, as Tim was talking about that allows employers to make contributions to Roth 401ks. Before that, that wasn't something that was happening. And so if they were going to match a contribution that you made, they were going to match that in your traditional IRA. So you didn't get the tax-free growth and the tax-free withdrawal benefit, but you still got the tax-free growth in the traditional IRA. So at least you got something.
Yeah, for sure. And not all companies can offer that, because I've heard some plans where it's like, yes, you have a Roth 401k, but the contribution is still going to go in the traditional. But the point is that there are more and more options available, and it's important to talk to your employer to see what might be available for you. Talk too about how Roth IRAs can be really beneficial from a perspective of not having those required minimum distributions later in retirement.
Sure. So, with the traditional account, whether it's a 401k or an IRA, you're going to have required minimum distributions or RMDs. It's pretty simple. The Roth doesn't. Now, it works a little different for beneficiaries. We've done a past show on the Secure Act and some of the changes there.
Right.
But one key thing I want to make sure that our audience knows is there is these different 5-year rules. There's technically 2 different 5-year rules. One's called the forever 5-year rule that pertains to the first deposit, as Jeremy put it, first contribution you make to a Roth IRA. And it is for the tax year. So let's say it's April 14th of 2025. If you make a prior year contribution for 2024 to your Roth IRA, the clock starts January 1st, 2024. Okay. And then you're 5 years. The idea, though, is you need to be at least 59 and a half. and wait the 5 years in order for it to be a truly qualified distribution. But here's the key, and this is why having a trusted ally in your corner is so critical. Let's say that you have a 401k but not a IRA, and you think, oh, well, I'm contributing to my Roth 401k, therefore my 5-year clock is started. And then you retire, you roll your Roth 401k out to a Roth IRA, it's your first contribution to a Roth IRA. You turn around and take that money out, what's gonna happen?
You're going to get hit.
You're going to get hit because you did not meet the requirement for the 5 years for a Roth IRA. They don't overlap. So that's why, we always recommend folks just put $1 in a Roth IRA. Let's get that clock started. But folks, it comes down to, again, having someone in your corner that understands the intricacies of these rules. We do. We've educated not only ourselves, but our entire team of elite advisors understand how these rules work. We're continuing to stay on top of this for you to make sure that you don't run afoul of those rules. And you, again, get to keep more money in your pocket versus it going to Washington.
I am so excited to continue this conversation with you because we have a lot more strategies to share with you at home about how to remove your wealth from Washington. But if you would like some help engaging in the strategic tax planning process for your retirement, this is why Tim and Jeremy and the team of Stonebridge Wealth Systems are offering you the opportunity to claim your very own complimentary written financial plan. Now, this is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how they can help and serve you. And you're going to be able to even see what your potential tax burden would be in retirement and then begin to work to see how you can minimize it even now. To claim yours, that number to call is there on the bottom of your screen, 866-256-7778. Or if you have your smartphone handy, you're also welcome to pull that out. You can open up the camera app, just point, click, and scan that QR code that you see there down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team from Stonebridge Wealth Systems will reach out to connect with you to schedule your complimentary meeting that way as well. Don't go anywhere. We've got a lot more strategies to share about how you can remove your wealth from Washington right after this.
My story started when I was in college. I was trying to figure out what I wanted to do. I knew it was going to be in the financial industry. I took a lot of accounting and finance classes. I thought I'd probably work in like a bigger company and work my way through maybe the accounting department. But then when I was doing a internship the summer before my senior year, I walked into a business. I was trying to sell magazine ads. I don't know if I call it magazine ads, but basically ad space in the back of the UNK student handbook and planner, which was a difficult sell because, nobody uses pen and paper planners anymore, at least not college students. But I made my best pitch to some financial advisors. I happened to be Scott Noctegal that I met with that day. When I went for the close and tried to see if he was ready to sign up for some ad space, he said, yeah, no, I'm not interested in that, but it takes a lot of courage to have somebody to be willing to walk into a business, especially a business that really doesn't cater to your target audience, to put yourself out there in a way that the odds of you being successful are probably pretty low. That's the type of person we'd be looking for at our firm. Have you decided what you want to do? And I said, no, I really haven't, but I know I want to work with finance because I like numbers and math's always been my favorite subject, and working with kind of complex equations, almost like a puzzle. And so that's really where it all began.
Welcome back, Nebraska. You're watching The Retirement Compass, brought to you by the team of Stonebridge Wealth Systems. I'm your host, Kristen Oakley, here with both Tim Kulhanek and Jeremy Gove. And today we are talking about how to remove your wealth from Washington. It is so important to pay attention to your potential tax bill in retirement and take steps proactively, even now, to potentially lower that tax burden for yourself. We were talking about Roth IRAs in the last segment, and we've talked about this on previous shows as well. Enacting the Roth conversion strategy. Now, one of the things I think it's important to highlight, some folks might hear the word Roth IRA and think, well, I earn too much. I can't do a Roth conversion. Let's first talk about what a Roth conversion is and then explain why it's actually a strategy that most people can and probably should be employing right now.
Yeah, I mean, the government took the lid off the income cap, I think, in 2010 for making Roth conversions. So, yes, there are income limits for making Roth contributions. That's I can make $7,000 contribution if I'm 50 or older. I get the catch up of $1,000 per year. But that doesn't apply to a conversion. So, if you want to convert your entire IRA in 1 year,
your traditional IRA,
don't.
Right.
Yeah,
don't do that.
Don't. But you can.
Because, and why shouldn't you?
And why shouldn't you? Because, and this goes to the conversation, is like a Roth conversion, it has to be for the right fit, right? For the right situation, for the right client. Because there's different times that you would want to do a Roth conversion and not. So like a lot of people would argue, there's two different schools of thought here. A lot of people would argue, hey, you should wait until after you retire to do conversions because you'll have lower income. But you have to look at where the tax brackets are right now. So most people right now that we work with are either in the 22 or 24% bracket. Some are in 12, but most are 22 to 24. Well, let's just say I'm in the 22% bracket. I could do a conversion all the way to the top of the next tax bracket, and it only costs me an extra 2%. Right, 22 to 24, it's not that big of a deal. And besides, if I said, yeah, but Tim, I'm gonna be in the 22% bracket in the future, great, let's still do it. Let's save the 1% because 22 is gonna go to 25. That's why 24% is probably my favorite tax bracket. The other reason is because the way that Medicare premiums are assessed is based off your income 2 years prior. So it'd almost be ideal if you could get your conversions done, all the heavy lifting done before age 63. Because when you're 65, if you retire and you go on Medicare, your premiums from an income perspective, we call it an IRMA, income-related monthly adjustment amount, are going to be based off your income when you're 63. So if we can get the heavy lifting done without giving you too much heartburn along the way, by 63, you're going to have a lower, and that's effectively a tax, right? A lower cost long-term. Now, I want to give an example just real briefly of like how this works and like in practice why this is important.
Great.
So one of the times that we like to do conversions if there's a down market. So if you go back, Jeremy, if you remember during the pandemic, we did a lot of conversions at the bottom of that V. We were convert as much as you can. Think about it this way. Let's say you had 1,000 shares of NVIDIA stock. Now I'm picking NVIDIA because it's the kind of crown jewel here. But October 11th, 2022, so not even pandemic. Let's go back to the end, towards the end of 2022. The price was $11.59 a share. So that was $11,590.
Right.
You convert it and you pay tax on $11,590. Today, how much is that tax-free growth and money available for distribution in the future worth? $120,560.
Wow.
So $110,000, roughly $110,000 of tax-free growth. So when we're doing this, I'm working on a plan right now. And if you remember the 3 tax buckets that we put on the screen oftentimes, we've got taxable, tax-deferred, tax-free. I've got a client right now whose taxable bucket is $395,000, tax-deferred is $1.9 million, tax-free or Roth is $481,000. They need about $100,000 a year. If they convert, up to the top of the 22% bracket, so for them 22% happens to be the sweet spot, over the next 10 to 12 years, if rates just go back to where they were, so I'm not talking about the big increases that people like David Walker, former Comptroller General of the United States, basically the chief auditor of the US government says, hey, tax rates are going to go up much more than what they were in 2017. If they just go back to where they were, the end result is they get about 70% of their money on the tax-free side of the equation. It saves them over $380,000 in federal taxes paid over their retirement, and it saves their beneficiaries, in other words, it increases the overall value of their estate for their beneficiaries by roughly $500,000. It's another $500,000 just in added value. Now, that's not because Tim is good at picking funds or stocks or anything like that. This is the value of a financial advisor who's a holistic planner. Is, hey, if we can come up with an extra $500,000 for you and your beneficiaries over your lifetime, would that be something that's interesting to you? I think most people are going to take us up on that offer.
Absolutely. Well, it's like we say on the show often, how you make a decision in one area of your financial life can and will affect all the others. That's why you cannot afford not to look at these things from that comprehensive, holistic point of view. And there was so much goodness packed in that example. I'm like, we need to get a chart of that. I'm sure our viewers would like to see that as well. But if the answer is, would you like to add $500,000 potentially, right, to your retirement, then into your beneficiaries and your estate, that's a huge difference right there.
Absolutely.
And that's what these tax saving strategies can potentially do for folks. Let's move on our list. Another type of non-taxable income are financial gifts. And this is kind of in 2 parts. So let's first talk about the gift limit, if you will.
Yeah, so the gift limit, I always have to look this up every year. It changes slightly.
Change, right?
Yeah, and so for 2024, it's $18,000. So that means Me and my wife can give one person $18,000 each. So a total of $36,000 if we want to.
You could give $18,000, your wife could
She could give $18,000.
And
yep.
that's not taxed.
That is not taxed. It doesn't have to be added as income. There's really, no tax due if we do that, right? And so that's a good deal. But if you want to take advantage of the high tax or the I forgot what the
Unified credit.
Unified credit. Thank you. The high unified credits right now are $13.6 million per person, and so if you want to take advantage of that before 2026, before that drops down, there might be some real estate planning that you could do. If you have, let's say, for example, a farm, you have $10 or $12 million worth of land, there might be some estate planning that you would want to do now versus waiting till that drops back down to probably $5 million or less. And it's going to keep getting smaller and smaller, most likely, as time progresses.
Right, because Uncle Sam is wanting to get his fingers in that as much as possible, right? Yeah. Well, let's now talk about charitable gifts. So we've talked about just financial gifts, you giving to a loved one, for example, but charitable gifts have another strategy that we've done an entire show on, and that is QCD's, qualified charitable distribution. So touch on that briefly.
Yeah, so basically a QCD is saying, hey, instead of writing a check, to the church, so mom and dad writing a check to First Baptist Church there, you know what, they're 70.5. Guess what? They can take advantage of what's called a QCD, or qualified charitable distribution. If you're over 73, so you have to be 70.5 to take advantage of this. But if you're over 73, then you already have to take the money out anyway. So it's like, okay, well, I got to take this. Let's say it's like $5,000 I have to take out. I'm just picking a round number. And I was going to give that $5,000 to the charity or to the church in this example. I can write the check to the church for $5,000 after I take it out, pay the taxes on it. It's going to go to my AGI, or adjusted gross income, which then is going to have implications for Social Security taxation, a whole host of other things. Or I could just have my custodian, say Fidelity Investments or Charles Schwab, I could just have them send the check directly to the church on my behalf. I never take possession of it. I don't have to pay taxes, so I kind of get a double dip in a way. It's one of the biggest benefits of the tax code, because not only do I get the big deduction from the standard deduction, but I also avoid the taxation on the distribution. It counts towards my required minimum distribution, so I don't have to take more than that out if I don't need it. And I actually am able to give more money to the church, because before I was having to pay taxes on that $5,000, which means I was actually having to take $6,200 out to net the $5,000. Here, all $5,000 is going to work, or I could just up it to $62,000. So your money goes further. Right.
So that's another way to remove your wealth from Washington, for sure.
Yeah.
That's right.
Well, let's shift gears now and talk a little bit about life insurance proceeds. And I know you also want to talk about something known as LIRPs. So let's talk about that category of non-taxable income.
Yeah. So like we had put in the notes here, a huge percentage. So there's two major loopholes in the tax code, in my opinion. One would be like the estate tax and gift tax that Jeremy was talking about.
Right.
Because let's say you're Elon Musk and you're worth hundreds of billions of dollars. He doesn't have to pay estate tax. How so? He can just give everyone on the planet up to $18,000, be very generous, give away all your money, and there would be no estate tax, because that exemption is per person.
Right. Yep.
So he can give $18,000 to Kristen and Tim.
That would be so nice. I'm
Shout out. We're available.
Thank you, Elon.
The second is life insurance, okay? And there's a reason why probably 90% of senators, according to some studies, 85% of congresspeople use this strategy. I call it a LIRP, stands for Life Insurance Retirement Plan. The largest corporations, Fortune 500 companies, have used these as kind of like executive benefit plans for a long, long time. It's, again, what Ed Slott calls one of the biggest loopholes in the tax code. And according to accountingtoday.com, in 2016, 92% of Fortune 500 companies offered deferred compensation plans, and 83% of supplemental executive retirement plans used life insurance, or in this case, what we're calling LIRP. It's basically pretty simple. A lot of people understand that, hey, when I'm younger, I need to have life insurance because I want to protect my family, loss of income, that sort of thing. And then they think, I'm older, I got things paid off, I'm close to retirement, I don't need it. Where this comes into play is we're actually able to grow cash value inside of this plan. So think about like a big bucket fills up with cash. There's a little spigot on that bucket. It's dripping out premiums to pay for the life insurance. But at that time, the drops are really small. The increase in your cash is much higher. And when you take it out later on, it's all tax-free. So it's a pretty unique strategy. It has to be implemented properly, so you want to make sure you're working with somebody who's familiar with this type of planning, but it's something that we do on the regular here at Stonebridge.
Which I'm so glad you're bringing some light to this, because I think it's very telling that so many people in our government have these types of plans and most Americans have never heard of them. So
Correct.
Thank you for shedding light. If that's something that piques your interest or you would like to learn more to see, hey, is that a strategy that could be right for me? This again is why Tim and Jeremy are offering you the opportunity to receive your very own complimentary written financial plan. To claim yours, simply call 866-256-7778, or again, you're welcome to scan that QR code. More on how to remove your wealth from Washington right after this.
As Americans, we strive for better, from a better house to a better career to a better life for our children and grandchildren. Better has become the American way. But when it comes to your retirement, what does better mean to you? More income, a flexible lifestyle, better solutions? Yet a better retirement begins with a better financial plan. To get your complimentary written financial plan, call the number you see here. You only retire once. This is your opportunity to plan for better.
Welcome back, Nebraska. You're watching The Retirement Compass, where today we've been talking all about how to remove your wealth from Washington. Tim and Jeremy, my goodness, so many strategies, so little time. There's even some that we haven't had a chance to get to yet. I think it's important, with only a couple minutes left in the show here, to really just wrap up what we've been talking about, why it's important, and what folks need to take away from today's show.
Yeah, I mean, I think at the end of the day, we have to take stock of what the experts are saying. And now that's changed over the last few years, but the people who know what the books look like. So I use David Walker often on the show as an example. He was the chief auditor for the US government, and he's been sounding the alarm since 2010 that, hey, because of things like the aging population, baby boomers, to maintain Social Security and Medicare, Medicaid, interest on the debt, the government will massively have to raise revenue, and that means rising taxes. So whether it's contributing to a Roth IRA, converting to a Roth IRA, contributing to a Roth 401k, or like we just talked about, the LIRP, or Life Insurance Retirement Plan, that's the one that most people haven't heard of. But if you think about the benefits of these, like the Roths are really important and critical. But if you summarize the benefits of that LIRP real quick, since it's kind of an unknown, there's no age 59 and a half rule like there is with the other plans. You don't get a 1099. There's no income limit on participating. There's no contribution limits. You can put in as much as you want. And over the life of the program, it ends up costing roughly the same as what you pay on your managed money already. So to learn more about that and other strategies to keep your money in your pocket and away from Washington, call the number on the screen. It's a complimentary written financial plan. We look forward to seeing you soon.
Wonderful. Tim and Jeremy, thank you so much. As always, it's such a joy to be with you. And thank you for joining us. Again, that number to call to get your complimentary written financial plan is 866-256-7778. We know that there's a lot of questions that you might have that today's show raised. What better way to get your questions answered than by coming in and sitting down one-on-one to figure out how you can help remove your wealth from Washington. Thanks so much for joining us. We look forward to being back with you next time here on The Retirement Compass.